Hi there. In this video, we are going to learn how to pick common stocks as a defensive investor. Let's quickly recap the definition of a defensive investor. We went over this in the last few videos, but a defensive investor is one who does not have enough time and energy to spend on building and maintaining their stock portfolio. So there's nothing wrong to be a defensive investor, but you could still pick common stocks. And for those category of people who do not actually have a lot of time and energy or the enthusiasm or the motivation to pick stocks, what is the best way to pick stocks? So the thing to think about is, as a defensive investor, if you're constantly looking at the stock markets, there's something wrong. So you ideally want to get into the attitude of, I don't know anything about the stock markets and I don't really care what's happening day to day on a stock market. And all I do is dollar cost averaging. So refusing to being active is the most important lesson I have learned to be a successful defensive investor. So there are 4 rules that Benjamin Graham shares in this book of common stock picking for a defensive investor. The number 1 is you should have active diversification. At the minimum, 10 stocks across varieties of sectors, and at the maximum of 30 common stocks. So no less than 10, no more than 30. It's just too difficult to have anything in mind for greater than 30 stocks. Number 2, large, prominent, and stable companies in your portfolio. All of these are very important adjectives of a company. Large company, based on current dollar terms, would be greater than $10 billion in market cap, having at least $1 billion in sales. And this company in your portfolio should be conservatively financed. So what does that mean? We'll get into in the next slide. But it's basically saying the finance of the company is very healthy and stable. And it should be stable for at least 10 years. The market cap has to be much bigger, so that's what large is. Earnings should be greater than 0, so earnings per share should be greater than 0. Earnings growth every year should be greater than 3%. And price that you pay for the company or the market cap over its total earnings should be less than 15. So that's the PE ratio, ideally. And price to book should be less than 1.5. Book value is assets minus the liability. It's the actual value of the company. If you were to sell everything today, what would you get? So price is what is the perception or the market cap of the company. So price earnings less than 15, price to book less than 1.5, earnings growth greater than 3%, greater than 10 billion. So this is what would be your barometer of picking stocks in any stock screener tools that you use. So that's the second rule. Third rule, dividend payments. The company should have a long record, greater than 10 years of continuous dividend payments, and hopefully increasing their payments because their earnings is increasing, and so they have a proportionate increase in their dividend payments. And it should be at a good price. You cannot buy a company at a very high valuation and expect to make money. If you get into the company at a very large, lofty valuations, then it'll take a long time before you could actually make money. So Benjamin Graham says less than 25 times average earnings or 20 times the last 12 months earnings. So that should be the maximum that you should be willing to pay for a given company. Good management is an important thing to keep in mind. The company should have a stable and good management history, should be ethical and doing the right set of things. That's the 5th one, which is not, I think, in the book, but I think it's an important one. So these are the 4 or 5 important rules. That's it. Those are the simple rules that we should look at. So now let's get into the details of what does conservatively financed mean. So there are many ratios that we should get familiar with. There is a current ratio, which basically is saying all the assets, including inventory, over its liabilities. So it should be ideally greater than 1. Or there's this different ratio called quick ratio. It doesn't include all the inventory because you might have a lot of inventory, but you cannot probably sell all of this. So this is basically saying, is this company liquid? Can it sell? Can it pay for its bills? And if you were to sell everything today, is it net positive or is it net negative? So it should have a good, healthy current or a quick ratio. These are two different ratios. Quick ratio doesn't have inventory inside it. Current ratio does. Book value is assets minus liability. Ideally, this should be greater than 0. It's basically a factor of the actual real intrinsic value of the company. Always remember that the current assets, if you were to sell as is, there's this long-term goodwill that you built. There's a lot of things that you cannot have strong assets backing. Um, there's a lot of things that goes into building a company, the customer relationships and a whole host of things that are very hard if you were to just do assets minus liability. So book value is very useful, I believe, when there is a very high intensive industrial, like product based company, but even there is some amount of discounting that you need to have, but ideally greater than 0. Price to book, which is basically overall market cap of the company as to what is the perception of the company or the value of the company today versus the actual value of assets minus liability. So ideally this should be close to, if it's less than or 0, less than 1, then that means it's trading at a discount. You're buying $1 at less than $1. Ideally this will be slightly above, but if you get a company that's less than 1 price to book, that means you're getting it at a significant discount. Price to earnings is price per share upon earnings per share, like how much dollars do I have to pay to get $1 in earnings generated. Ideally less than 10 is a good one for a defensive investor. Remember all of these factors, earnings per share as well, what is the dollar generated for every dollar invested in the company? Greater than whatever the greater amount is better, right? But all of these, remember, are from the lens of a defensive investor, the person who has the attitude of, I don't care what's going on in the stock market. Every month I have a dollar cost averaging and I buy these high quality, large industry leaders, ethical companies for a long period of time, and I just forget. So these are the terms that are also very valuable, because think about this. If you were to buy a large company, then there's going to be a little bit less fluctuations because they have a very high moat around running their business and whole host of things. So this is pretty good rule of thumb when you think of picking your stocks as to how do you classify those stocks. So I did an exercise. I actually went through 2 airlines, Delta Airlines and Southwest, and I tried to do my homework to really understand what is the share price, what's the market capitalization of each of these companies. These aren't billions of dollars, this is dollars. And so revenue, 44 billion versus 21 billion, almost less than half for Southwest. Profit, etc. And then I tried to do dividend per share and then earnings per share, and I was able to find out Southwest gets less dividend, and then earnings for every dollar per share, Southwest does much more. The yield on the earnings that I get is $10. So every $50 or every $54 of share that I buy, it can make 10%. So that's a great return, right? So yield based on my dividend payout, I can say it's 10%. And then the payout ratio is basically saying how much money am I getting out of this company from the money that they make. So 2.5% would be a 25% payout ratio. And then current ratio, we talked about it. This is assets over liabilities. Price to book is total market cap upon assets minus liabilities, the book value. So ideally this should be less than 1.5. Found out that they are not. Microsoft, on the other case, is a much higher current ratio. It's greater than 2. So that's what I found out, that it's a much higher, much stabler in terms of liquidity when it comes to Microsoft compared to Delta Airlines and Southwest. I also found out that the market cap is almost 30% more, and then the revenue is much higher, and then they're able to keep a lot of money as well. So then this can give you a good indication. Price to earnings should be less than 10. So this is 9.5. Higher dividend payout. So you can make a pretty good. They do have a different segment. I think this is only local, but they go beyond US. So you can do this to really understand like what's going on between different companies if you are confused as to which stock to buy. There's a lot of details that can go into looking at the stock as well. It comes to revenue. In this case, I'm looking at Delta Airlines, and then you have cost for goods sold, like how much did they actually, value did they actually provide for the money that goes into actually selling. And then the profits, operating income, income tax. So gross profits is basically from all for all the revenue, all the flight tickets. This I get $44 billion as a company, Delta Airlines, and then 28 billion goes into actually just the basic cost of operating my business. It's not even something that I just need that much money to give that much value. So then the gross profit is $16 billion. There are whole kinds of expenses that they have to go through, operating expenses, and so if you subtract all of this, then you get to an operating income, which is basically this is the net profit, right? This is not net profit; it's operating income, and then there you have to pay taxes. When you pay taxes, then you get the net income. In this case, it's $3.9 billion. That's quite good, almost making like $5 billion in income and $4 billion in net income, with an earnings per share of 5.6. So that's a pretty good financial understanding, and you should probably look at the company for many years. In this case, I'm looking at it for 8 years. Ideally, if you look at it for more than 10 years, you get a pretty good rhythm of understanding of whether the revenues is growing, is the profit growing, is it have a spike up in there. So it's very important to look at the financial statement before you buy any stock. So why not growth stocks for a defensive investor? As I said, growth stocks are too uncertain. They have a lot of risk and volatility. And so it'll be very hard for a lot of people to have emotions under check to actually buy stocks that are 10, 20% down every 2 months or every month. Right? You will be like, what's going on? But for a large, stable company, that will not happen. It'll be very mature. So you can actually buy at a good price over every month. So this is another data point. Every growth stock or even the large stock has gone down in 6 months by 50%, a lot of them. So this volatility is just too hard for a lot of people to manage. And finally, let's understand what are the risks in investing. What are the real risks? Real risk is when a company deteriorates, it starts to lose money, and if you start seeing the income going down or the revenue is slowing down, then that's a problem. If the price is insane, then if you get in at that price, there's nothing to save you. That is the most important factor you need to understand. Are you paying a very high price for the company that you're getting into? And if you time the market and say, hey, this is the low point or this is the high point, I should buy more or I should sell more, and that's a problem. You need to constantly buy for a long period of time. So timing the market is it's a risky situation. So these are the 3 real risks. Timing the markets as to when to buy and when to sell. You just have to constantly buy for a long period of time. If you buy at a price at a lot of shares at a very high price, it's a very hard game. You have to be in for the very long term if that's where you get in. So actually divide it up, buy it over a long period of time, and then make sure you have an eye on whether the company's profits are going down. So now let's take a look at the stock screener demo. It's like, how do you actually go about picking these companies with all of these ratios that we talked about? So what I found out reading this book was there are a lot of these websites which I didn't know before. This one is Macro Trends, where you can take a look at various companies. You can say, hey, I want to look at companies more than, so there are 491 companies, and you can say, hey, I want to look at companies that have market cap of at least $1 billion. So then it'll say, oh, you only have 227. So remember, we have to pick companies that are more than $10 billion. So if you go that, you only have to pick from 681. So it's getting easier. Now you don't have to look through 4,700, but only 681. Then you say, hey, I want to look at companies that are less than 10 or less than 20 P, let's say. So it's a 400 company. Again, 30 to 50% reduction. You say, hey, I want a company that gives me at least 2% dividends. Wow, only 250 companies. Wow, it's getting better. And then if I say, hey, I want a company that have price to book ratio of 1, let's say, 52 companies. So this is basically saying the companies that are not too overvalued than what its intrinsic value is. So now you just got 52 companies to go through, and you can actually make this even higher. Let's say, hey, I want to look at companies only $100 billion. Now you got 7 stocks to look through. And that gives you a pretty good investment picks to go from. And then you can look at these companies from various sectors. You can look at their market caps. You can look at the closing prices and a whole host of other things on macro trends or any other such websites. Hopefully that was useful to find out like what kind of screener demos and screener websites exist out there for you to start picking stock. So in summary, let's quickly recap. Investor knowledge, experience, and temperament. These are the three most successful ingredients. You got to learn on a daily basis to improve your knowledge. If you don't learn and if you just invest without really knowing, then that's a problem. You should be using the tools, you should understand some of these ratios and make your own independent judgment. At the same time, there are many such reports that come out. One such is this Argus report that I was looking at for Walmart stores. It gives you a pretty detailed understanding and also gives you ratings of what is the analysis of this company, what are the current financials of the company, valuations, the notes, the descriptions, financial, and a lot of details as to where it falls compared to Costco. It talks about like various strengths of dividends, issues with management, or positive sentiment around the company. You get to know so much about the company. So reading some of these analyst reports is also very helpful. So investor knowledge is something that we should constantly be investing in and building our experience and temperament to actually stay in the market. It's the most important thing. Large companies are much more stable than defensive for defensive investors. Temperament, we went through why. Knowledge about how little you know about the future coupled with acceptance of ignorance is the defensive investor's most powerful weapon. Not timing the market, not looking at the market every day, very helpful to win this investment game. Big advances gives feelings of safety and big declines in the stock market gives the feeling of risk. This is a paradox. It should be opposite. The very act of crashing or the stock's pricing collapsing is taking the risk out of the system. So you should be investing more. So constant dollar cost averaging is the way to go. Financial test. Do not buy a company because you use the product of that company. It's a very bad idea. I've done it. I failed from learning through it. I think that's a very bad idea to just pick companies for the products that you use. You should look at their finances, make sure they have a good amount of liquidity, make sure their earnings are growing, make sure that the competition is something that they're taking care of. All of that you need to probe into. If not, you're going to lose a lot of money. Dollar cost averaging is the way to go for defensive investors, and make sure that you don't enter into the market at a very high peak. And you can find out based on the learnings from the previous videos if the market sentiment is too bullish, too bearish, etc. So reinvest all the dividends that you made into stocks. Most important. Finally, this is the key thing. What is going on in the stock market? If someone asks, you should be like, I don't know, I don't care. I invest, I buy international, I buy local, I have bonds, and it's a fixed ratio, and every 3 months or 6 months I rebalance. So that's the way to go. Thanks a lot.